Great to be with you today, and we're excited about our conversation here. My name is Mike Scattis. I am the CEO with PIA National, and we're excited about this conversation. And you know, agency succession planning, it's an important topic for PIA members. They've got a lot of questions about what's the best way to plan for their future, whether they're looking to sell the agency to an outside partner or pass it along to one of their family members or something else. And with today's webinar, we hope to bring more information and value to your agencies. The PIA National Carrier Council, which was the PIA partnership, produces tools and resources for agencies. It's also looking at agency succession planning. And right now, it's identifying areas where agencies can benefit from this information. So this presentation today, Chris, is very timely, and we're really delighted to have you with us. Chris Hughes, we're excited you're here with us today to present discussing some of the key things agencies need to know about succession planning, such as projecting future earnings, understanding valuation metrics, different methodologies, what are the key pieces of a deal. And Chris Hughes himself is the managing director with M&A Services, which is a specialist advisory and financial services firm in the insurance and reinsurance industry. He specializes in retail insurance agencies, MGAs, MGUs, program administrators, wholesaler insurance agencies, and ancillary insurance businesses. So prior to M&A Services, Chris served as the senior product manager at Hartford Financial Services. And this is just a reminder. We want this to be informational as well as interactive. So please add your questions and comments to the chat, which Sam will be monitoring for us. And Chris, thank you very much. I turn it over to you.
Mike, thanks so much for having me today. I'm super excited about this this webinar today. So today, again, my name is Chris Hughes. I'm a managing director at M&A Services. We're a boutique investment bank exclusively serving the insurance industry. I head up our distribution practice, and by insurance distribution, I mean retail agencies, wholesale agencies, MGAs or MGUs, any type of firm that sells the insurance product. And we are focused on property and casualty insurance agencies, as well as health insurance agencies or employee benefits agencies. Not so much pure life insurance agencies. That's a different business model than your P&C or employee benefits agencies, but those are the type of businesses that I work on. Our firm also works on a large number of insurance carrier transactions, and we have a sister company, a FINRA regulated broker-dealer, M&A Capital Services. So most of us in the firm are registered reps regulated by FINRA in one way or another. Today's presentation is going to be on insurance distribution firms valuations. How do I value an insurance agency? What's the current market for insurance agencies? And what are some common deal structures in there? And then we're going to touch on just a couple of deal structuring, and tax considerations. Myself and colleague Stephen Scales put together this presentation. Stephen is our top senior associate at M&A Services. He holds a CFA certification and does all things Excel's presentations. Just a great resource there. Today's objectives: one, we're going to talk about the primary valuation methodology for insurance agencies. How are insurance agencies valued? We're going to go over a pro forma income statement. We're going to show an example and show how to go from an actual income statement to create a pro forma income statement that gives you the metrics that you need to value an insurance agency. We'll talk about the current market, who the buyers are, what the publicly traded companies look like, and what the current valuation metrics are for the insurance agencies. And then we're going to go through two very common and very specific deal structures based on the pro forma income statement. And lastly, we're going to talk a little bit about actual deal structuring and the tax consequences of different deal structures. So we're hoping to accomplish quite a bit here in the next, say, 40 to 45 minutes. With that, I'm just going to get started. I'm going to take a couple of breaks after we've talked about how to create a pro forma income statement, after we get to the deal structuring portion of it, to take any questions that you have. And if it's not covered by the presentation, feel free to ask questions, any questions that you have on valuation or deal structures, I'm sure I'll be able to either answer those or direct you in the right direction. So the main method to value an insurance agency is a multiple of pro forma EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. And the reason that everyone looks at EBITDA versus net income is EBITDA for any kind of capital provider, whether that's an equity investor, private equity group, a buyer, or even a debt provider. They're looking at what's your earnings of the business outside of, any kind of your tax structure versus my tax structure, or your interest structure versus our debt structure, and depreciation and amortization are non-operating cash type of things. So everyone looks at EBITDA. And then pro forma is the normalization of a privately held insurance agency looking more like a corporately owned agency. So there's not any kind of expenses that would go through that are personal to the owner. So you make adjustments the most common one is an owner operator may have an above market or below market salary or compensation structure. So you put a market compensation structure in for the owner. Any kind of excess or redundant staffing, so oftentimes there's family members that are involved in an agency's expense structure, but not really in the operations of the business. You may have long-term employees that you've kept on the books that may not be necessary for the continued operation of the business. You make adjustments for any extraordinary one-time non-recurring income or expenses. Primarily in the income, you might see this if you're a P&C or an employee benefits agency, the one-time sale of a life insurance or one-time sale of a large annuity product, which it really isn't the norm there, and it's a non-recurring revenue item. And in the expenses, you might have all kinds of things. You could have one-time IT expenses. You could have one-time server expenses. You could have one-time conversions to a new agency management system. Any of those things that are one-time non-recurring. You could move offices where you have a lot of moving expenses. Those things you would adjust out. Personal expenses. So we're going to go through an actual income statement and show some of the expenses and adjustments that we made to come up with our pro forma EBITDA. This is an anonymous income statement, but this is a live deal that we did not too long ago, and we'll show you a couple of the deal structures and offers that we got into it. And then the last adjustments that you make to this are the things that are just definitional to EBITDA, meaning income taxes, interest income and interest expense, depreciation and amortization. Once you make those adjustments, then we get to the pro forma EBITDA. So what you do, and just this is a income statement, these are the adjustments that we made, and this is the pro forma income statement over here in this column here to arrive at our pro forma EBITDA. And the time period that you're looking for is the most recent trailing 12 months period. So as we set here on August 27, 2025, if we were coming up to say, what's the value of my agency, we would look at the most recent trailing 12 months period, which would be August 1st of 2024 through July 31st of 2025. And you would take your actual income statement, and we've summarized some of these categories. So we have compensation expense, selling expenses, admin expenses. Of course, there's going to be, a number of line items below there, but just in terms of putting together this presentation, we've summarized all of those. So if we take a look at the actual revenue, we have $5.4 million in commission and fees, $400,000 in contingency income, $75,000 in interest income, and $25,000 in other non-core income. The adjustments that we make to this are we take out the interest income as definitional to EBITDA, and the $25,000 non-core income. This was the sale of a one-time life insurance product. So it's a non-recurring commission item. So you would adjust those out. So we start with total revenue of $6 million. We adjust out these two items to get to $5.9 million in pro forma revenue. Just to take an aside, for contingency income, we left in the trailing 12 months for this specific project of $425 because every year it's, somewhere between 375 and 450 year over year. But if there's a lot of variation, say one year it's $100,000, the next year it's $800,000, the next year it's $600,000, and it's really all over the board. Oftentimes you might take an average of the 3 or 5 year contingency or profit sharing income and average those out to create a more normalized pro forma contingency line item. In this example, we just didn't have to do that. So that's where we come up with the, again, total revenue of $6 million in the actual income statement, and then move into 5.9 in the pro forma income statement. On the expense line items, we've made an adjustment to payroll expense. So one, we normalized the owner-operator's compensation to what a market compensation would be for a president/producer. And then also the owner's spouse was in the expense structure, but she was not really in the operations of the business at all. And she was also having some benefits and taxes taken out. So we make that adjustment here of $236,000 to bring everyone to market, to remove a non-operating spouse from the expense structure. And then we make the corresponding, adjustment to any employee benefits and any payroll taxes that were for those persons. So we made $273,000. We took out $273,000 in the compensation expense line item there. On selling expenses, we removed the personal country club dues, personal travel, personal auto, and personal boat expenses that were being expensed through the actual income statement. We took out $118,000 here to arrive at a normalized $266,000 in selling expenses. Now, oftentimes there are charitable contributions in here. You could have more than one car in there. I've seen children's college tuition expenses in there. I've seen jets in there. There's any number of things that, as you're running a personal family-run business, that run through the expense structure. Some of those things are necessary to run the business, and some of them, those are not. In this circumstance, we took out the country club dues, although if his primary method of getting new business is going through the country club, you might leave those in there. In this case, it wasn't. If you do have auto expense, and you can either do it by mileage, or, hey, we do pay for the cars of our primary producers. If those are necessary to run the business and you're doing a lot of driving, you might leave those in. And here, it just wasn't. It was personal to the owner. So we make those adjustments there. In the administrative expenses, we adjusted out a one-time IT expense. They had just put in new servers, so there was $70-some thousand of IT expenses there. And then we have a one-time professional fee that's non-recurring in nature that we adjusted out. And then in a lot of agencies, the agency owner also owns the building that they're in. And again, they may or may not charge market rent because they are both the recipient of the building's income as well as the agency's income. But you do want to normalize that to what the market rent and market lease is. So we adjusted out $15,000 to bring that back down to what a market rent is for that. And then we take out all of the interest expense, income taxes, depreciation, and amortization. And the reason that you would see a lot of depreciation or amortization in an insurance agency income statement is most of the time, any agency that's made any acquisition of a book of business or bought out a producer or bought another agency, they're able to amortize that expense over a 15-year period. So you might see, a significant depreciation or amortization expense in any agency that's made some acquisitions in the past. So you make all of those adjustments, and we had a actual income statement with $6 million in revenue, showing $1.6 million in EBITDA at a 27.7% EBITDA margin. When we make these adjustments, we have a agency with pro forma revenue of $5.9 million, and then showing EBITDA, a significant increase in the EBITDA to just over $2 million in pro forma EBITDA at a 34.7% EBITDA margin. Now, most agencies, retail agencies, run it somewhere between a 25 and 40% pro forma EBITDA margin. Some that are a little bit more either, non-standard auto or, heavy personal lines that might require a little bit more expense and resources, more employees, those can run a little bit lower. Or if it's really small commercial, those can run at lower EBITDA margins. And then you see some, commercial lines, middle market agencies running at a little bit higher EBITDA margins. But anywhere between, say, 25 and 40% is what you see most often. There are some outliers in that 40 to 50% EBITDA margin, and sometimes you might see a little bit lower for some reason. But this is a well-run 35% EBITDA margin, pro forma EBITDA margin agency. So I'm going to just pause here and say that this example, this pro forma income statement, is what's going to run through the valuation and the specific deals that we show here.
Okay, Chris, are you ready for some questions?
Sure.
Okay, wonderful. So I do just have one question, I think, just with regards to what you're speaking about currently. And the question is just, isn't EBITDA before interest expense not interest income? So I think they're just questioning just to make sure that they understand.
Yeah, so generally you take out interest income and interest expense. If the interest income is part of the actual business, like with an insurance carrier, right? Interest income, that's a big deal because they're holding so much assets, right? They've taken all the premium in, they put it into bonds, and they're getting 5% interest on the. So interest income for an insurance carrier is absolutely an operating income to the business. But for an insurance agency, you don't really have you're not really holding a big balance sheet with a lot of interest income, or generally you're not doing that. So in general, you would take out the interest income for an insurance agency unless there's a real rationale of why you're holding so much cash and generating interest income there.
Okay, and it looks like currently that is the only question that we've had asked live. So I'll save some of those other questions for when it pertains more to what you're speaking about.
Okay, great. So we're going to leave this pro forma income statement here. So we got 5.9 in pro forma revenue, to just over $2 million in pro forma EBITDA. And how our agency's valued, this pro forma EBITDA is the primary metric. So you really want a professional, or you really want to be very careful to make all of these adjustments to a very, sustainable market rate for any kind of capital providers, whether you're looking for debt and that's a bank, or whether you're looking to market your agency and you're looking for investors or buyers. These are the multiples that are applied at different levels of EBITDA. So it's the larger the agency, the more scale the agency has, the higher the multiples paid. So any agency that's, say, $200,000 or $300,000 in EBITDA all the way up to about $2 million in the EBITDA, those would attract multiples in the 8 to 10 times multiple of pro forma EBITDA range. And when we're using these multiples, we're talking about cash at closing kind of base valuations. Any kind of earnouts or equity or any other kind of deal constructs that go into it would be in addition to this. But if you're just looking for the base valuation of what's my agency worth on a cash basis, these are the valuation multiples right now. Once you get to $2 to $5 million, you become a little bit more of a platform, and you attract quite a bit of interest from a number of different buyers, publicly traded companies, definitely the aggregators out there, a few pure play private equity groups that really focus on smaller deals, and those multiples would be anywhere from 10 to 12.5 times multiple of EBITDA. And then once you get to kind of a $5 million EBITDA range, that means you're probably in the 12 to 15 to $20 million revenue range. You become a platform for a lot of different companies and pure play private equity groups, and you can attract anywhere from a 12.5 to a 14.5 times multiple of EBITDA. And the reason that you run into kind of that 14.5 ceiling is there's a number of big deals that happened over the last 18 months. You had Aon acquiring NFP, you had AJ Gallagher acquiring Assured Partners. Actually, that deal just closed. It was announced about 4 or 5 months ago, but it just closed last week. Brown & Brown acquiring Risk Strategies, and Marsh acquiring McGriff. So those were big publicly traded companies acquiring very large, aggregators. Those deals were between 8 and $14 billion. And all of those traded in the 14 to 16 times multiple of EBITDA range. So those very large, diverse firms, that's really the ceiling of what the private markets are trading at today. One of your questions might be, hey, why would I trade at an 8 versus a 10 or a 10 versus a 12? In the pro forma example that we showed here at $2 million of EBITDA, we're going to show you that traded closer to 12. Actually, it traded a little bit higher than 12, but we're going to show an example of the deal structures at a 12 times multiple of EBITDA. And there's a number of different drivers that go into that. You have the size and the scale of the operation, which we just discussed. Organic growth is a big driver here. So most of the publicly traded brokers and very, very large privately held brokers are trading in the mid to high single digit organic growth percentages. So if you're growing at more than, say, 10% compounded annual growth rate year over year, that can increase the value of your business. Having a strong management team, having a strong producer bench, that increases the value of your business. Having a lot of risk mitigation factors in terms of client concentration risk, producer concentration risk, carrier concentration risk. If you have a number of carriers, you have a bench of 5 to 10 producers that are all producing business for you. You have good contracts in place with your producers. You have strong carrier contracts. There's non-competes, non-solicits with your producers. They have good incentive programs to produce organic growth. All of those go into, whether something's worth an 8 times or a 10 times. There's also the mix of business. So just some types of insurance distribution firms are valued higher than others. So if you have like non-standard auto has a much lower renewal or retention rate of business than your high net worth personal lines. So non-standard auto might attract lower multiples than a high net worth personal lines business. Same with employee benefits. Employee benefits firms that have, say, 50 to 100 lives for each one of their clients can be valued more so than individual health, ACA, or Medicare Advantage plans. As individual, there's just a lot more churn with single individuals as there are large, small to mid-size employee benefit firms. So those are the types of things that would change a value from an 8 times to a 10 times or a 10 times to a 12 times. In the case of the example that we're showing here, they had a very strong management team in place. It was corporate owned. They had a president that was also a producer. They had a corporate CFO. They had 7, young dynamic producers that were generating more than a 15% CAGR on an organic growth basis. It was a very profitable business. It just was a great business. So it attracted just over a 12 times multiple and just over $2 million in pro forma EBITDA. The acquisition market, so this just shows the number of announced transactions that have happened over the course of the last decade. And you can see, all the way up until COVID, we're in a very low interest rate environment, near 0% federal interest rate environment. And, the market's really robust at 650, 700 transactions a year, all the way through 2020. COVID hits, at the end of 2019, just the first quarter of 2020. And there's a big pause in the marketplace as everyone's starting to digest, well, what does this mean for our business? And outside of insurance agencies that focused on maybe cruise lines or the restaurant industry, those industries taking a big hit, a lot of them going out of business in that first half of 2020, a lot of federal money started flowing into, the system. And that federal money went a lot to private equity groups, and they found, hey, the insurance distribution model, this recurring revenue model is very attractive. We're going to put a lot of money into that. And you see that happening in the second half of 2020, but really a lot of that money. And you can see this is bifurcated between private capital, the light blue here, versus public, the dark blue here. and the private money that flowed in there, the private equity money that flowed into these deals in 2021 and even a little bit into 2022 is just extraordinary. So you see just a lot of deals that happened, announced transactions that happened. This does not take into account small tuck-ins that weren't announced, so these deal numbers might even be higher. But these are announced transactions. You see them tailing off, and in 2022, 2023, you see the interest rates start to spike as well as, you know, the inflation went to, you know, nearly 9%. Interest rates followed very quickly thereafter. We thought we were going to see a pause in deal volume, and we thought we were going to see, you know, some downward pressure on deal valuations. But what we saw were some of the more aggressive buyers out there, the acquisitions and the PCFs that were a little that were very leveraged, using a lot of debt. They took a pause in their activity, but what we saw was some of the publicly traded and less leveraged companies like your Hubs and your AJ Gallagher's just step right into their space in that first year, maybe 24, and now you see PCF and Acrisure having recapitalized, and now are back in the space as we walk into 2025. As we currently sit here, we're going to finish, I think, 2025 in a similar place to 2024, maybe a few more deals, maybe a few less, but right at that 700, you know, plus mark for 2025. And now that we have some direction with this big tax bill that was passed over the summer, we know that capital gains rates aren't likely to change in the 25 to 26 year. We know that interest rates are in a fairly stable place. Maybe there's going to be a little bit of a drop in interest rates in the fourth quarter of this year, but we're in a relatively stable tax and interest rate environment. So we see for the foreseeable future a very strong seller's market with a very strong stable of buyers for the remainder of 25 into 26. In 2024, these were all the major buyers you saw, and most of them backed by different private equity groups. So InsureZone backed by BHMS, and then an investment for Lightyear recently. Broad Street Partners, you don't really see their name so much, but they own, you know, 24 to 28 platform agencies, and those platforms are doing their own investing. They just recapitalized with Ethos last year. Hub International had a new financing round last year. Keystone Agency, then you have AJ Gallagher being a publicly traded company. And then some of the major aggregators out there that are, say, 500 million in revenue to about 1.2 billion in revenue. You have High Street Partners, Alkeem, World, PCF, which is now called Trucordia, the Hill Group, and King. All of these are very, you know, they do 20 deals every year, year in and year out. And most of those have recapitalized this past year to 2 years in 2025, 25, 23, 25. And I think you'll see a couple more of those recap this year. The Hill Group has been held for the last 5 years, so I think there's something there. Relation is due to recapitalize, I think, this year, and maybe the Allura Group as well. It's just been a private equity holding period is anywhere from 4 to say 6 years out. So I think you'll see a little bit more recapitalization in those groups coming up this year and next year. And then in terms of what the publicly traded brokers are trading at, you can see here on a enterprise value to EBITDA, this last column here, those average at 17 times, and you have, you know, AJ Gallagher trading at 21 times, Aon trading at 17, Brown & Brown trading at 17, Marsh trading at 15. Those are as of August 15th this year, so just a couple of weeks ago. But you can see that there's still an arbitrage, even if they're acquiring something at a 14 or a 15 times multiple of EBITDA, there's still a valuation arbitrage that they're realizing when they acquire these larger, you know, platforms. So that's kind of where the market is today and who the buyers are today. I'll pause here if you have any question on the number of transactions that are going on, who the buyers are, and what the publicly traded companies are trading at.
Chris, I will just wait for any more questions to come in, but I do have two here for you. The first one is, what is a typical valuation process and what factors are considered?
The typical valuation process, again, the very start of it is to go through and start with your trailing 12 months income statement, make appropriate adjustments, pro forma adjustments, normalizing it to what a corporate run entity would look like, and coming up with that trailing 12 months pro forma income. Once you've done this, you would also do this for like the full year 2024 and the full year 2023 so that there's a historic trend. And you'd also project out, well, what does this look like for full year 2025? And what's my projection for full year 2026? And when you're doing those projections, you kind of look at your history. So if I've been growing at a 10% compounded annual growth rate the last 3 years in a row, and through this trailing 12 months projection period, you don't want to throw in a 90% growth rate for your 2025 and 2026 projection. You don't want to be too aggressive. You might not want to be too conservative. You want to be very realistic in your projections because that's much more believable when you're looking to raise either debt or equity out there in the markets. But once you come up with this trailing 12 months EBITDA, pro forma EBITDA, then you apply an appropriate multiple to that. And that's how you would come up with, that's the process for determining your valuation.
Okay, great, thank you. And then just one more question here was, what are some of the things I can do to increase the value of my agency?
Sure, so some of the things that you would do to increase the value of your agency is making sure that you have good contracts in place with your producers. And good contracts mean, solid non-solicit agreements, solid incentive plans to incentivize growth, that you have a good management team in place and that it's not a one-man show. So if you're an owner operator, that you have a little bit of an infrastructure in front of you, that you have solid IT systems in place, that you're using, market-based CRM system, that you're using the market-based agency management systems, that you have a good mix of business that you're plugging into your clients, so that if you do have, some client concentration, that it's not just one product that you're selling into them, but you have multiple product lines going into there, that you have a good system to create organic growth, or if you are in the M&A space and you're looking to acquire, that you have a good debt structure, a good debt partner involved so that you're able to show that your acquisitions are accretive to your earnings and creating value. And that you have a good slate of products and services in place. So all of these items go into, enhancing the value of your agency.
Wonderful. And I just have one more, I guess it's more of a comment. They're just wanting to make sure they understand the figures. So if they just are asking, if a small agency has about a 400K EBITDA, you could possibly sell for 2.4 million.
If you have $400,000 in EBITDA, in pro forma EBITDA, and you're operating at, say, a 40% EBITDA margin, then you're probably right at $1 million in revenue. I would think that you could trade probably at, an 8 times multiple, so right at $3 million, $3 to $3.2 million would be this is back of the envelope math off the top of my head. But if you're at $400,000 in pro forma EBITDA and you're saying you're at $500,000 in revenue, there's a little bit of a mismatch there, and no one's going to give you that kind of valuation. So you'd really want to look at your revenue as well. So when you're looking at revenue and you're less than $500,000 in EBITDA, you have to still be operating at that, 30 to 40% EBITDA margin on a normalized basis. And one of the reasons that you might not see that is you might not have a market comp for the owner operator of that business. But if you put a normalized, 40-35 commission structure in there for the owner, and you're starting at $1 million in revenue, right? You have 40% of that, or 35-40% of that going to owner's compensation. That brings that number down to about $600,000. then you have other producers, other staff in there, occupancy expense, admin expense, selling, advertising expense, to get down to that $400,000 of EBITDA, then absolutely, I think you could trade at like an 8 to 9 times multiple of EBITDA. But if you're at $500,000 in revenue and you're saying you're at $400,000 in pro forma EBITDA, and you're not taking anything out of the business and you're running at that high of an EBITDA margin, you're likely to be more valued on a, maybe a multiple of revenue about 3 times. So I think it really depends on the revenue as well as what the expense structure looks like to get into that $400,000 of EBITDA.
Okay, I think that is all of the questions I can see for now. I have a few that were sent in that we will go over once you're all done here.
Okay, great. So now I'm gonna just go back to this. Oh,
sorry, Chris, just give me 1 second. It looks like we just have one more question. It just popped in here as soon as I said that.
Sure.
And it refers to what we were just speaking about. So it just says, how does it affect your payout if your EBITDA margin is 70%?
So if your EBITDA margin is 70%, I think you really want to look at your pro forma adjustments to make sure that you've made all the adjustments. Like I mentioned before, if you're $1 million in revenue and you're operating at a 70% EBITDA margin, you haven't really considered making an adjustment for pro forma compensation. So most producers are paid 40, 30, 40, 35% for new and renewal business. And as soon as you put in that 40, 35 commission expense for the owner operator or for producers, your $1 million of revenue is paying out, say, $350,000 or $400,000 of your revenue in commission expense. So it immediately drops from $1 million in revenue to, $600,000 or $650,000 of net income. And then from there, you have to pay other employees, you have to pay your selling expenses, you have to pay your rent, you have to pay your administrative expenses. So to run at a 70% EBITDA margin, you just haven't made the, an appropriate market adjustment for owner operator compensation.
Okay, and it looks like that person that just asked that question just said that it is a true EBITDA 70% margin. So they're just wondering if that were the case, how that would apply.
Yep. So I have seen businesses that run at a 70% EBITDA margin. Most of those that I've seen run like that are MGAs that are getting significant profit sharing and participating in the underwriting profit of the business. So they're not paying out commissions on the underwriting profit of the business. But if it's a true 70% EBITDA margin, it's defensible and you have all the market comp in there, I wouldn't see any reason that you couldn't get the same multiples that you would if it was running at a 35 or 40% EBITDA margin. So the multiples may be appropriate. So if you're running a $1 million revenue agency that's getting $700,000 of EBITDA, you might be able to get, an 8, 9, or 10 times off of that 70%, but you just really have to have a very defensible expense structure and believable, right? So if you're going to a bank to borrow money, the bank's going to want to know that you can cover the interest expense, interest and principal that you're paying back every year, and that 70% EBITDA margins producing cash that can do that. And from a buyer's standpoint, they're like, well, if we're going to pay, a multiple of 8, 9, 10 times, that has to be a sustainable margin going forward for a number of years, even if we are spending some money on selling expense to create organic growth there.
Okay, and it looks like this conversation is definitely popping up quite a few questions for you, Chris. Okay. So a couple more have come in. So someone just wanted to confirm that the numbers you're discussing are cash at sale and then equity or earnout are in addition. So they just want to make sure that they're understanding the numbers you're discussing.
That's exactly right. So when we look at this chart here, these multiples that I'm talking about here are cash at closing base consideration multiples.
Okay, wonderful.
I'm going to go through a couple of deal structures in just a minute, and we're going to show how buyer's equity comes into play and how earnouts come into play. But for a base valuation, we'll show that these are the multiples that you can expect cash at closing.
Okay, and then I just have another one here. They're just stating that they're a smaller agency and they were told that their selling price should be roughly 2.5 times their income. Would that be?
I think it really depends on the agency. So if you're a smaller agency, you're a PNC agency and your standard lines, right? Small commercial or high net worth personal or even standard personal, I think, just on average, it's probably closer to a 3 times multiple than it is a 2.5, just in today's market. If you're really, really small, maybe it would be smaller. If you have a spattering of non-standard auto or individual health in there, or life insurance, non-recurring life or annuity insurance in there, it could be closer to 2 or 2.5. But I think in general, the market's a little bit higher than that for very small agencies.
Okay, wonderful. And I'm just going to ask you one more question, and then we are going to move on. And any other questions that pop up, we can discuss after. This one is just asking, what resources are there for smaller agencies, less than 2 million, for legal contracts and employee contracts?
So if you could call me offline, I can give you a couple of different resources. So if you're west of the Mississippi, there's a gentleman named Kevin Grant that I would recommend. And if you're east of the Mississippi, Richard Satin would be an attorney that I would recommend. But I even have state-specific attorneys for, say, Florida, Illinois, Texas. I mean, just different states. You generally want a M&A attorney that works on insurance agency transactions. Not so much, you don't need the big white shoe law firms that might be cost prohibitive. But any attorney that works on, say, $2 million valuation agencies all the way up to $50 million agencies, they're going to be very cost efficient because they do agency transactions day in and day out. And they know all of the terminology, they know all of the deal structures, they know most of the buyers. So they're very efficient. Even though the rates might seem high from an hourly standpoint, they're very cost effective in getting insurance agencies to the finish line at a reasonable rate.
Okay, wonderful. Well, thank you so much for answering all of those questions. We'll let you move on, and we'll save whatever questions we get in after that for after you're done here.
Sure. So this next portion, I'm going to talk a little bit about common deal structures. So here are the deal components that go into a lot of deals. So of course you have cash and equivalents. Equivalents I put in there just because that, if it's AJ Gallagher, maybe you get 75% cash, 25% AJ Gallagher stock. But because AJ Gallagher is publicly traded, that stock is just like cash. You can sell it the very next day. So there's cash and equivalents. That's what those multiples that we were applying relate to. There's buyer's equity. So a lot of those other buyers that are private equity backed, your Hill Groups, your World Insurance, your InsureZone, your King Insurance, Alkene, those all would like to put some of their own equity into a deal. So you'll see one example here on the next page where it's 75% cash at closing and 25% buyer's equity. So that's also a common deal structure. Some buyers allow you to retain a portion of your own equity. So it might be 50% cash at closing, 25% buyer's equity, 25% seller's equity. And you can hold your own equity. And generally, when you do hold your own equity, there's a predetermined time period and valuation metric to sell that equity later on. In every deal structure that we see, there's some kind of earnout. And earnouts over the last 5 years have morphed into not, you have to earn your full purchase price, but so much more so that here's your cash at closing number. And then in addition to that, here's some earnout that you can get on top of your closing consideration. So it's more like icing on a cake, right? The cake being your cash at closing, and here's an earnout. And most of those earnouts are based on a compounded annual growth rate of either net revenue or EBITDA over a certain hurdle rate. And then in much smaller transactions or when you're selling to employees or producers of your own firm, or there's one local firm buying another local firm, and these are, you know, smaller deals that range in value, say from $500,000 to $2 million. You may have some seller financing piece to it, and you may also have some debt piece to it, where they're going to someone like a, you know, a Bankwell, an Insure Bank, a Live Oak, or an Oak Street Funding. Those are, you know, forward, you know, lenders that this is their specific vertical. This is what they focus on, and you'll have them borrowing money to do a smaller deal. So these are all the different components that go into deals, but again, the most common one are in every deal, closing consideration. There's earnouts to every deal. Earnouts can run from 1, 2, 3, or sometimes up to 5 years. I think 3 years is the most common earnout period. And then you have buyer and seller's equity that can be a component of a deal. So I'm going to show you 2 very common deal structures and deals based on that pro forma income statement that we went through. So this is just a offer comparison. So once we go to market, we've marketed an agency, we get a number of different offers. We've narrowed it down to 2 offers that the seller is considering, and we try to put them on a, you know, apples to apples comparison. So for that pro forma income statement, we had 5.9 million in pro forma revenue. We had just over 2 million in pro forma EBITDA. Both of these offers came in at a 12 times multiple of that pro forma EBITDA. And we throw this at a 5% annual growth rate just to show kind of an apples to apples comparison. I'm going to go through the details of each of these offers, but you can see they're very similar. One's much more cash at closing heavy. One has some buyer's equity involved there. In offer A, what they've done is they've acquired 100% of the assets of the company at a 12 times multiple of EBITDA. They're paying 75% of that cash at closing, and they're paying 25% of that as buyer's equity. So in this deal, they're paying 18.4 million cash at closing, and they're issuing the seller 6.1 million of their equity. So they're rolling the seller's equity of the business into the buyer's equity of the business of $6 million. In general, when you're taking buyer's equity, this is an illiquid asset, so you have no determination of when you might be able to sell it or what the price of it is. What we've seen most often and what we use to model out here is we put a 25% compounded annual growth rate of that equity running out for 3 years. And then we show them exiting at the end of 3 years using this $6 million investment, growing at 25% compounded annual growth rate for 3 years and then selling that. This is one of the most common earnouts that we see as well, is we have a 5 times multiple of any growth of EBITDA each year over a 3% hurdle rate. So you have to grow EBITDA at least 3% before you get into the earnout. And then for every dollar above that for each year, you get a 5 times multiple. So if you grow at EBITDA at 20%, at the end of year 1, you'll get another $1.7 million. You grow it again at 20%. At the end of year 2, you get about 2.1. And then at the end of year 3, you get another $2.3 million. So using this and assuming that the buyer's equity grows at 25%, you're able to exit at the end of 3 years, you grow at 20%, the cumulative deal value is $37 million, although you got $18 million cash at closing. We show this in a scenario where you get a 0% growth rate. So if you just remain the same and you don't get into any earnout at all, but that buyer's equity still continues to grow at 25%, it's a $30 million deal. We didn't show a scenario where you didn't trade this or the buyer's equity doesn't grow at all, but that could be another scenario where you're holding the equity for a longer period of time. Again, it's a private held illiquid asset, so there is a little bit of risk there to it, but this is a very common deal structure that you'll see with the private equity backed aggregators, the Hill Group, World Insurance, InsureZone, Alkeem, world insurance. I mean, this is just a common deal structure that you see out there. In the second deal, what we have here is a much more cash heavy deal. And you see this a lot with the publicly traded offers. And you see this a lot with offers that don't have to use or don't want to use their own equity to do deals. So again, this is 100% of the assets of the company using a 12 times multiple of EBITDA. And this is just paying 95% of that cash at closing. So at closing, rather than getting $18 million, the seller is getting $23.3 million. And at the end of the 2-year period, rather than 3, you're taking the average of the forward 2 years of EBITDA, and you're applying that same 12x multiple to it and truing it up. So if you grow it 20% year 1 and 20% at the end of year 2, you times the growth of that by 12, and there's another $7 million. So you're getting $31 million. While it's lower than in offer A, you do get that $23.3 million right at closing, and you do get this additional $7 million at the end of year 2 versus spread out over the end of year 3. And there's no illiquid investment to take. You can take this and put this in the S&P 500. You can take it and buy treasury bills with you. If you don't grow at all, because they paid 95% of that deal cash at closing, you're just getting trued up for the remainder of that 5% here at the end of year 2. So this is a much more cash heavy, less risk, but again, could be less reward, just depending on how the buyer's equity works out and how the earnout works out. So those are 2 very common deal structures in the market today. And then if you're looking at different deals, whether you're going with a bank or whether you're doing it yourself, or look at different deals, you try to compare them on kind of an apples to apples comparison. So I'll pause here to see if there's any questions about deal structure on these specific deal structures. And if there's not, I'm just going to go into whether something's an asset deal or a stock deal and some of the tax considerations that are for different types of entities. Okay, well, most deals, I would say 80 to 85% of all insurance agency transactions are structured as an asset purchase and not a stock purchase. So the reason for that are, 1, a buyer is able, the sale of an agency is primarily a sale of goodwill. There's not really any inventory. There's not really any equipment. There's very little, physical property whatsoever. It's really the goodwill of the business. So a buyer is able to take the purchase price of all of that goodwill and amortize it over 15 years. So there's a real tax, advantage to being able to amortize the purchase price of the deal over 15 years. And 2, they don't have to take all of the known and unknown liabilities of that business. They're able to just buy the assets and not buy any of the liabilities, or not take on any of the liabilities unless they want to. Maybe there's a bank loan in there that they're like, hey, that's a really good interest rate, we'll assume that liability, but they're able to pick and choose which liabilities they want and don't want. Versus in a stock sale, the buyer's on the hook for all known and unknown liabilities post-transaction. So for those reasons, the tax advantage and the taking on the known and unknown liabilities, 80 to 85% of all insurance agency deals are asset purchases. From a seller standpoint, if you're a pass-through tax entity, so that would include LLCs, S corporations, limited liability partnerships, limited partnerships, any type of pass-through tax entity, generally you're taxed at long-term capital gains rates one time. So it's a one-time, it's a favorable tax environment. So it works for both buyers and sellers. The exception to that rule is if the seller is a C corporation. And if the seller is a C corporation and you do an asset deal, the C corporation itself are selling those assets. Once the cash from the transaction comes into the C corporation is taxed on that. And then there's less cash to distribute out to the shareholders. And once that distribution of the remaining cash goes out to the shareholders of that C corporation are taxed. So there's a double taxation event that has a real tax implication. So just at a federal level, if you're a C corporation and you do an asset deal and you're not making any kind of mitigating deal circumstances, you do a $23.3 million deal, $500,000 basis. There's a $5 million corporate tax that is paid. The distribution to the shareholders is an 18.5, and they're taxed another $3.7 million. Whereas if you were an S corporation doing this or an LLC doing this type of deal, there's only one level of taxation. And just on a federal level, this is $3.8 million in additional taxes that the C corporation would pay. And this is just the federal tax. So most states have a state tax that would be paid both at the corporate and at the individual level. So there's two levels of state taxes that would be paid. So if you're in California, you can add another 13% onto this one, and you can add another 13% onto this one. So California, New York, New Jersey, Massachusetts, Connecticut, some of the higher state income tax states, this double taxation can be deal prohibitive. There's ways to overcome this. So you can, depending on the facts and circumstances of the deal, you can apply, personal goodwill to a C corporation and say, hey, it's not really the C corporation's business. It's my name brand. It's, Hughes Insurance Agency LLC. It's Chris Hughes. That's really the value of the deal. So you can mitigate this using a personal goodwill strategy, depending on the facts and circumstances. You can have the buyer pay, just do a stock deal rather than an asset deal that eliminates this. And not everyone needs to amortize those assets over 15 years. There's some buyers out there that don't need that. And then third, you can look at going from a C Corp to an S Corporation. And if you are a C Corporation and you're a small business, I would advise you to talk to your tax advisor right now and see, what are the tax implications of becoming an S Corporation and how long do you have to be an S Corporation? You can't just convert that this year and then realize this benefit. Actually, there's a 5-year built-in gains period that you would have to wait before you can realize the full value of that S corporation conversion. So that's a couple of tax considerations and deal considerations of whether you want to do an asset purchase or a stock purchase and the different implications for a pass-through entity versus a C corporation. That's toward the end of our presentation here. We're coming right up on 4 o'clock, but if you have any final questions, you can ask them now. And if you have any follow-up question, here's my email address. It's chughes, Hughes, at M as in Mary, A as in Apple, services.com. And my direct number is 860-748-1910. Feel free to email or call or text me directly. But that's our presentation, and happy to take any final questions that you would like to have.
Okay, Chris, it looks like there are a couple more questions. If you don't mind answering them, we'll just get these questions in. So maybe if someone needs to rewatch further answers after because they have to head out, it'll be included with the recording. So the first question I have was sent in, and they're just stating that presently their ownership is a single member LLC. They're considering a change to an S sub corporation to be able to transfer ownership to family by shares of stock. They're just wondering if this is a good concept or there might be a better method.
So I think one, they should talk to their local attorney that set up their company, but I think that you can have a multi-member LLC, so I'm not sure that you would have to convert to an S corporation to do that. There's plenty of LLCs that we've sold that have multiple owners. There's plenty of S corps. So from a tax perspective, and a deal perspective, I don't think it matters one way or the other whether you're an LLC or an S corporation. But I do think that you should talk to an attorney and whether it's really hard to change from a single member to a multi-member LLC. I don't believe that it is. And I don't know that you would have to change to an S corporation. I think that's more of a tax filing. I think you could file your tax returns as an S corporation, even if you are an LLC. Again, that's just a little bit above my pay grade, but I don't think that there's any deal risk there. I don't think that there's any additional tax consequence of selling from an LLC to an S corporation. And I think you can be a multi-member LLC or a multi-member S corporation. And if memory serves me correctly, I think the real limitation on an S corporation is whether you have, after a certain number of investors, maybe it's 100, or whether you have some international investors, you might be better served as an LLC versus an S corporation.
Okay, and I do have another question here. It said, if you have agents that own their business, how do you fairly compensate them out of the final payout? Also, suggest any processes to help them get ready for that.
Yep. So one thing I didn't mention in this presentation that maybe I should have is sometimes you have an agency that has, producers that are being paid 50-50 compensation, new and renewal, or you have 1099 producers that are being paid 50-50 new and renewal. And when you're going through a sale, right, the buyer's going to want to make sure that those 50-50 producers are back at market compensation, maybe 40-35 or 40-30, right? So that creates additional commission expense, which creates more EBITDA for you. And when you're creating more EBITDA, you're creating a higher valuation. So if you're selling your agency for, say, $10 million, and the producers are going to have to go from a 50-50 to a 40-30 compensation structure, and that created, say, $2 million worth of that value, of that $10 million valuation, you can take that $2 million and you can share that with your producers to make them happy in, one, doing a deal, two, signing a new employment contract, a new non-compete, a non-solicit with the buyer, and just having a very welcoming, transition and accepting a lower compensation structure going forward. So you can work that out with individual producers. And if they're 1099s, most buyers want them to become W-2s, at the transition. So you could use that additional value that you've made as converting a 1099 to a W-2 at closing. And generally, it's within the seller's discretion on whether you want to share all of that $2 million, more of it, less of it. Those are really facts and circumstances that are dependent on each individual agency and the value that any individual producer brings to the table. I've seen some deals where they're very, very large producers, and they're treated just like an owner of the agency on a pro rata share of the revenue that they bring into the agency versus the agency themselves. So even though they were 0% owners, they were treated just like, full-fledged owners.
Okay, great. Another question was, what does a cash out deal look like if you do not stay on and work?
So in general, buyers would like to see you stay on and work for, a 1 to 3 year transition period. And, in general, there's an earn-out. So everyone's interests are aligned and you staying on and you grow in the business at 3 to 5 years. But if you're just at a point and you're like, hey, I just want to sell my business and move on, generally there won't be much of an earn-out. There might be a little bit of a holdback for a 12 to 18 month period to prove out, because now it's a riskier deal for the buyer. So the buyer has done all their diligence, and you can get most of your cash at closing, but the buyer might want to escrow some portion of it to, hey, I told you I had $2 million in revenue. You've diligenced it, you've seen it, but really, are my clients going to stay on? And is the business what I told you it was? So there might be some escrow component to it, but in general, you should be able to get, a majority, if not all, of your cash at closing. But there wouldn't be really any buyer's equity, seller's equity, not really an earn-out, unless you have some key producers in there and you're allowing them to participate in an earn-out. Maybe you've structured that so that aligns the buyers and sellers' interest, and that could, bring you a little bit of additional valuation in terms of the cash at closing as well, if you aligned that and made it a little bit less risky for the buyer.
Sure. And another question that we have here is, can you do a personal goodwill if you're set up as an S Corp?
You can, but I don't think that there's any rationale or reason to do that. That might add a little bit more complexity to your deal, and you might not need it at all, but you can sell your personal goodwill along with the goodwill of the business.
Okay. Another question we have here is, in negotiating, please discuss exclusivity contracts, and should the seller demand a fee for doing one?
Okay, so in general, once you get to, I did another webinar, you can look at our website on M&A process, and I talk about that a little bit, and then I'm doing another webinar in the fourth quarter on due diligence and contracts, but really an exclusivity provision would come in your letter of intent, and all letters of intent have an exclusivity provision because the buyer is going to start committing money to hiring outside consultants to do financial diligence. They're going to commit resources to do an operational diligence, and they're going to hire attorneys to start drafting purchase agreements, employment agreements, and other contracts. So most buyers, once they submit a letter of intent, which is a written offer, also have an exclusivity period in there. And those periods generally run from 60, 90 to 120 days. They want, hey, we're going to spend 60 days or 90 days looking at this deal hard. We're going to commit resources and we're going to spend some money doing this. We don't want you shopping our deal to anybody else. So in general, in almost every sale process, we have an exclusivity period. Generally, sellers want that period to be as short as possible to make sure they have a deal. So you'd want to try to have that closer to 60 days if you possibly can. And can you charge like a breakup fee is really what the question is. That is very rare in the sale of an insurance, a smaller insurance agency, that you can command a breakup fee. We have seen it, but I would say, it's less than 10% of the cases are you able to say, hey, I'll give you 60 or 90 days of exclusivity. But if you don't do a deal, you have to pay us, some portion of money. I would say that is very infrequent. You see that in very, very large multi-billion-dollar deals, but you don't really see it in the private market for deals that are, say, less than $100 million in transaction value.
Okay, great. And
you can have some stages, so you can be creative and say, hey, I'll give you 30 days of exclusivity, assuming things are going well. At the end of 30 days, you can put down a $10,000 breakup fee and you can have another 30 days. But if the seller isn't like super forthcoming and you wait 29 days before you give them, all the financials and diligence, that doesn't really play that well. And generally within 30 days, you're going to see a lot of activity and diligence. And if you're not seeing that activity, often you can break up that exclusivity and say, hey, you're not really interested in doing a deal. And in general, the letters of intent also say either party can say, hey, we don't want to do a deal. And most buyers are like, hey, if we're not going to do a deal, we don't need this exclusivity.
Okay, and it looks like I just have 2 more questions on here. I'm hoping that they won't be too long so we can get everyone else out of here. We really appreciate everyone staying for these extra few minutes just to get sort of the answers that they're looking for. The next question would be, what could fees look like upon sale?
So fees are generally, the most expensive fees is our fees. So if you're looking to sell an agency, we run a process, we bring all these buyers and come up with your confidential information memorandum. Again, look at the M&A process webinar. I think it's like a 25 or 30-minute webinar that I did in the first quarter of this year. It talks through the whole timeline and everything. Your investment banker's fee is going to be probably the largest fee, and that's a percentage of the actual transaction value that happens. That's just ranges. It really depends on the size and complexity of the deal and what percentage is market. So if you go to myself or any of our competitors, you're generally getting a market rate, and that rate can be anywhere from, on a $100 million deal, that looks like 2 or 3%, at the very top. If you're doing a $10 million deal, it probably looks closer to, 4 or 5%. If you're doing a very, very small deal, it can be higher than that. So it just depends, and depending on what the seller is looking for, you can have kind of a bifurcated structure where it's a certain percentage up to a certain deal value, and then a certain percentage above that. So it incentivizes and aligns interest that way. Then you have attorney's fees. Again, you want to use a insurance M&A attorney, and the size and complexity of the deal. If you're doing a $100 million deal, those attorney's fees will probably run into the mid six figures. If you're doing a $10 million deal, it's probably going to be somewhere between, say, $40,000 and $60,000. If you're doing a $2 million transaction, it's probably closer to say $10,000 to $20,000 in attorney's fees, M&A attorney's fees. And then if you have an accountant or someone that's has to be intricately involved in a deal, most of the time, most small agency deals, the accountant's a small portion of the deal, so maybe $2,000 to $5,000. But I've seen some deals where the accountant is actually acting as the CFO or controller and is very actively involved, and it can run mid to high five figures, $50,000 to $100,000, just depending on the involvement of the accountant and the role that they play. But those would be the fees. You'd have investment banker fees, M&A attorney fees, and to a lesser extent, accountant fees. But those are the fees that you run into in doing a transaction.
Okay, wonderful. And then this is just one last question. We just had someone mention that they get calls all the time from potential buyers, and they try to talk them out of an M&A broker to save the fee. They're basically just wanting to know, they understand your value, but they're just wondering, why these, or how these buyers could better understand your value.
So sure. So if you're dealing with a buyer, and they're like, yep, you got a $6 million revenue agency, and here's your income statement. And they may make some downward adjustments to this $1.6 million in EBITDA. And you're just dealing with one buyer, and you don't do deals all the time, and you don't have multiple buyers coming in. The buyer is going to tell you what that pro forma EBITDA is going to be. They haven't made these market rate adjustments, right? Because you wouldn't know to make them, and the buyer's not going to make them for you in general. So you're going to get a lower EBITDA number, and it's going to sound good to you because this is your actual income statement. How would you know any different? And separately, they're not in a competitive process. And if they're not in a competitive process, they can say like, well, we're going to pay you a market value of 8, and 8 to 10 times is the range. It's the value of your agency. So one, you're starting with a lower pro forma EBITDA. And two, the buyer's not in the process, and he's not going to say, I'm not going to pay you, an aggressive multiple. I'm not going to turn that EBITDA one time. So you have two negatives there. So in this instance, maybe you're at 1.6, and maybe you're getting paid an 8 times multiple. So 1.6 times 8 is whatever, $12.5 million versus getting paid on $2 million of EBITDA at, say, a $10 million. So it becomes a $20 million. So knowing the market and running the competitive process maximizes the seller's value. And for the few percentage points that you're paying a banker, attorney, and accountant, it's well worth the process. And not just that, you want to get to a successful conclusion, right? So you don't want to get to a signed letter of intent and then not be able to go from, hey, I signed a deal at $15 million, and then we go through diligence and it becomes $10 million. A banker and an attorney is going to help make sure that if you sign a $15 million letter of intent, that you get to the finish line at a $15 million deal. And there's a lot to overcome and anticipate. And having done, hundreds of transactions, you're going to get the, experience both on the legal contracting side as well as the financial side of what all the pitfalls are to avoid to get you there.
Okay, well, thank you so much, Chris. There were a couple other little questions. I'll just send them over to you, and I can always have anybody that has some more questions reach out to you. They will be receiving a recording tomorrow, which has all of your contact information in the email as well. We just wanted to thank everyone so much for joining us today. PIA appreciates your interest in what we have to offer, and we really hope that this was informative. Mike, did you want to say anything before we sign off?
Thank you. Sorry, I was looking for the mute, but I've been listening. Chris, that was a great presentation. Thank you very much. And with all the questions that were coming in, you know that the attendees were engaged. So thank you very much for sharing your expertise with us today. We really appreciate it.
Yeah, thanks for having me. I appreciate it. I hope this has been helpful and useful to anyone, and feel free, PIA National or any of your attendees, and if you wanted to push this out to a greater audience, I'm happy to. I mean, your audience is really my audience.
Great.
Yep.
We would love to talk more about that. Let's figure out a way to do it.
All right. Thanks so much, Mike. I appreciate it.
Thank you, Chris. And thank you, Sam. Great job.
Wonderful. Thanks so much for coming, everybody.